Hello traders, this is Blake Morrow with ForexAnalytix, and you're listening to the week ahead video for August 30th, 2020. Hope everybody's having a great weekend. Now before we get into the charts and we get into what's going on last week or what's going on this next week and what had happened last week, first I need to say if you haven't tried out ForexAnalytix, you make sure you do so. It's only $1 for 10 days. That's all it is, just $1 for 10 days. Try it out. It doesn't matter if you're using the premium version or the light version, whatever one you decide to go with. The premium version is obviously going to have a few more bells and whistles, but you get a mobile app with both of them, okay? And while you're trying us out, you'll be able to use the premium version. So make sure you give ForexAnalytix a whirl. Join our community, get involved in our community. Make sure you jump in the chat rooms. That's probably where, the most of the time is spent with our traders. We're always talking about the markets and what's happening in the markets and keeping you abreast of new developments as they happen. So I'll see you guys there when you have an opportunity. But before then, let's talk about what happened last week. So last week, the equity markets continue to blast higher. I actually have some charts I need to show you regarding the S&P. But at the same time, the dollar also ended the week near its lows. And, the dollar is obviously trading heavy. And one of the things that I wanted to show you regarding the dollar, obviously we're back near support. It's interesting, the move in the dollar happened the day after Fed Chairman Powell's speech. If you look at, this is the dollar index, and you look at Thursday's move, we had this is just a neutral candle. It's a spinning top. And I'm like, oh, okay, maybe the dollar is going to hold up. And then Friday, the dollar really came under pressure. And we're challenging, once again, a multi-year trend line. And you can see this spawns back. This is the dollar index, by the way. This spawns back from 2011. You can see the low here in 2014. Takes us right to where the dollar's at. Plus, it's 127% extension of this. This is the... this move here, remember, this is the post-COVID lockdown move. So we've tested it once, and my fear is if we break it now, we are probably going to head back down towards 90, maybe even 88. Now, there's a lot of banks that earlier this last week that are trying to play this euro dollar head and shoulder pattern. You can see there's the head here. We would be carving out the right shoulder if that's the case. Since so many people are looking for a euro dollar head and shoulder pattern, I tend to believe that we're probably going to go higher before lower. And I wouldn't be surprised if the euro hit the 161% extension at this is 120 and a quarter, basically, almost 120.50. This is the post-COVID move, right? So the euro dollar probably is going here before lower. Now I may be wrong because we're heading into a pretty big week for the dollar. We have non-farm payroll, which will be this Friday on the 4th. That's obviously a big deal. And then, all the data heading into non-farm payroll this next week, whether you have, ADP, we got the ISM looks, looking at ISM data as it comes out ahead of the jobs report. So, and this is going to be a pretty big jobs report as well, because this might be the last jobs report that we see that, there was an analyst I was reading this morning about saying that the window is really closing on any type of stimulus package between now and the election. If you're following U.S. politics, the Democrats and the Republicans cannot come to an agreement on on a stimulus package for for the American people, and they're going to be looking at this employment data really carefully, and it might skew one side or the other into buckling into their negotiations. Obviously, if the employment data is really bad, the Democrats might have to settle for what the Republicans are offering, or vice versa. If the employment still looks pretty good, the Democrats might have to buckle and ask for less. So those are considerations coming into this week. Okay, and it's obviously going to influence the dollar from the weekly jobless or the weekly jobs report, and it's going to be a situation where the euro either tests 120.50 or we're heading back below 118. I do think there are a lot of buyers on dips in the euro. That means there's a lot of sellers in the dollar index on rallies, so that's something to keep in mind. Now, there's some pretty key developments as far as FX goes going into the end of the week. Now, also keep in mind that the end of the month flows that we saw on Friday probably were the end of the month flows for a lot of Europe, because UK banks, because of a holiday on Monday, they had to get their end of month flow out actually on Friday. So the outsized move that we saw in the dollar, you might have been able to attribute that to the end of month flows. And the banks that the analysis that I read suggests that we are going to have end of month dollar selling, especially against the euro and the pound. And so we got that. So Monday might be a little quieter as the end of month passes and all those flows have been done. But if you look at like the cable, I mean, the cable rallied. This has been, if you have tried to been directional, excuse my lack of ability to talk this morning. If you've been trying to be directional in the cable, it's been tough, because if you look at the way the pound has been trading, let's just go back to, you got a breakout, you got a false breakout, you got a breakout. I'm just showing you the daily candles. Wait, we're going to break out again. Wait, we're going to sell off again. Oh, we're definitely going to sell off again. Oh no, maybe that's a false breakout lower. Now we're going to rally, and then boom, we go. I mean, trying to be directional with the cable over the last 2 weeks. I mean, you can argue and say, well, I just bought the pound and I went long and I just stayed long. Yeah, that's not an easy trade either. I mean, you're up 50 pips, you're down 100 pips, you're up 25 pips, you're down 80 pips, you know what I mean? So that's been a very, very choppy currency to watch. But we did end the week, and it looks like we're going to end the month in breakout territory above 132. That's something to keep in mind. The Aussie, also big breakout above this channel that I was monitoring. We hit the 161% extension. We are overbought, and relative strength is not divergent. It would be if we stop here, because that means it's divergent from this peak as we hit new highs, and we're not hitting new highs in relative strength. But it's yet to be seen if the Aussie is actually going to stop here. Kiwi, it looked really heavy when we were down at 65 cents, and it did look like it was going to break back down below this multi-year. This is a multi-year trend line break. This big red line. If you guys don't recall, let me just show it to you. It's a multi-year trend line. We just came down, paused on it, and then ripped. So, but it did look vulnerable. Earlier in the week, I was like, man, we got to watch this Kiwi. It looks like it could break, but it didn't, and we rallied. The dollar Canadian, just a real quick overview. We know we have this down sloping, descending channel. We came and tested the bottom of that channel. This is a multi-year trend line too. This dotted line that you see here, and see it right through here. All right, that's from the highs. We're skating across the bottom of it. And I know it's difficult to see because I got a lot of fibs here, but 161% extension of this last bounce. we're basically on that trend line. And like I said, a lot of end of month flows, and they could end up reversing on Monday. So we just have to watch the price action on Monday. But this is the chart I really wanted to point out for you guys, is the S&P. So, and actually, you know what? Before I go into the S&P, let me go into the dollar yen first. I'm going to go into the dollar yen. This is before I go into the S&P. So, and actually, let me stop here, guys. If you like this video and you think this video is going to be beneficial to you into next week, and you're watching us on YouTube, make sure you give us a thumbs up. I'd really appreciate it. So would the rest of the team. Also, if you think this video is going to be beneficial to you next week and you saw this via social media, like you saw my tweet or maybe a tweet from the ForexAnalytix official Twitter for our company or one of our team members, give us a retweet to your followers. We'd really appreciate that too. Or if you saw us on Facebook, repost it. Any of those types of things really help us, and it motivates us to continue to make new free content for you guys every week. So I do appreciate that. Thank you. All right. I do need to talk about the dollar yen and then we're going to go into the S&P. Okay. The reason why I want to talk about the dollar yen is we saw a big reversal in the dollar yen. And this could have been partial end of month flows, but most of you probably know that Prime Minister Abe is going to step down for health reasons. Now, the reason why that's so important is because this whole move from, right here is when Abe, I remember it was right here, Abe announced he's going to do his 3-arrow approach to the economy. And the dollar yen went from 82 to 125. And that took December of 2012 to June of 2015 before it was all implemented, said and done. And I remember just everybody trying to fade that move. And for me, it was a really good, I just never faded it. I just continued to play it on the long side. It was a really good time in trading for me with these yen pairs as they squeezed. The fear is that because he is stepping down, a lot of his policies are going to disappear with his resignation. Does that mean we're going back to 80? No, probably not. But, some of his policies are going to end up getting unwound. And I think the risk is, and especially if equity markets start selling off or real yields turn lower, which the jury's out there. So don't rely on that necessarily. But if stocks turn lower at some point, chances of us retesting all this support down here at 100 and quite possibly breaking below, depending on the situation, I think is a realistic expectation over time. It's not going to happen, this week necessarily. But if you look at the false breakout that we had in the dollar yen, above the 106.50 level, that would scare me if I was long. I think the risk of a near-term move down to 104 is quite high. Now, so there's a chart I wanted to bring up in conjunction to this is the Aussie yen. By the way, I've got a new microphone on my desk, and it's a stationary microphone. It's much nicer than the headset that I once had. So I hope the sound is good for you guys. Hope you guys can hear everything. Maybe you can hear my lips, me drinking coffee and all sorts of fun stuff. Anyway, here's the Aussie yen. This is a multi-year trend line. As you saw, the Aussie looked a little overbought, very divergent. Dollar yen looks like it might roll over. So you put 2 and 2 together, and that might result in an Aussie yen turn lower. Now, if you notice the high here from 2014, peaks here in 2017, 2018, resistance coming into play right at 78. Now, this is a breakout, and you can see the blue line here, right? This is a breakout. a move back below the 77 yen level, or let's call it 76.50, in my opinion, would be a false breakout, but B, it would be a real disappointment to anybody who is long, especially if you look at, the bullish wedge breakout. So just keep an eye on the Aussie yen. I think that's a currency pair that we have to keep an eye on, because I want to show you something with the S&P. Okay, let me delete this. Let's go over to the S&P. Now, this is, I tweeted this last week, and I want you guys to see it because there's a few things that I found pretty important with this chart. Okay, first of all, yeah, I know the you're going to look at this and say, well, we're in a megaphone formation. That's what you pointed out on Twitter. Correct, we are. If you take this is the 200-day moving average, the red line. Do you see that? Okay. Look at the furthest distance that we travel away from the 200-day moving average. Okay. And when I say the furthest distance, let's just take the, let me make sure just need to make sure this is straight. Okay. So this is back in 2018. Like, I'm just going to take this red line, right? Okay, before COVID, right? That's about it, right? Post-COVID, we have exceeded the distance away from the 200-day moving average. Now, you could argue that and say, well, Blake, we had an outsized move lower, so of course we're going to get an outsized move, higher, the snap back. I get it. I can hear your argument, so we're going to stop with that. Now, let's zoom in a little bit. Okay. Let's take this low to that high. You'd say that's the first leg up, right? You could say that's the second leg. The reason why I say that's the second leg is, see how we hit a brief right here. See how we hit a brief new low, right? So that means the second leg started right there on a false breakdown. That in itself takes us to 35, roughly 35.50. Okay. Then you have, you can do it from minus that disaster there. AB equals CD, or if you want to do, that is the actual low, AB equals CD. So what I'm trying to point out is there is a risk that we head to 35.50, which is not far from where we're at. A lot of AB equals CD moves. We have really extended far from the 200-day moving average, further than we've been in recent time. And actually, without going back into the, 1920s or 1960s or whatever, just looking at the furthest way we've ever been away from the 200-day moving average on the upside, we're there in recent times. So my opinion is we are facing some pretty key resistance. Knowing that we're heading into the fall, going into an election season, might not get stimulus that the market is hoping or assuming that we're going to get. Just keep all this in mind as risk continues to move higher. I'm not saying that we can't go higher. I'm just saying that we are going to be facing a lot of resistance. So you have to start being extremely careful up at these levels. Personally, I'm not getting bearish risk, or in other words, I'm not going to get bearish equities unless we get back below 3,400. But that's pretty far away from where we're at. I mean, that's 100 S&P points. But, the flip side to that argument is we were just there last week or a week and a half ago. Okay. So, and you guys know the old saying, up on an escalator, down on an elevator, up on an escalator, down on an elevator, up on an escalator. If we come down, we can come down pretty quickly. So that's when they do the infamous rug pull in the market. So just keep that in mind as we move into this next week of trading. It is an important week as we have jobs, and there's other things too. By the way, Monday night, Tuesday morning, the RBA is meeting. So if you have any Aussie exposure, keep that in mind. As I showed you the Aussie dollar earlier, we have Australian GDP, and then we have Canadian and US employment at the end of the week. All right, guys, I know this video has gone on a little bit long, but I hope you got a lot out of it. I'll see you tomorrow morning on the F.A.C.E webinar for our free live webinars that we do every week. And if you don't know how to get there, there's a link in the description of this video. So you guys have a great remainder of your weekend. I'll see you tomorrow morning. My name is Blake Morrow with ForexAnalytix. Thanks for listening in.